All right. Welcome to our next edition of Executive Edge, the EKU Executive Edge. Really excited today. We got a special guest, Mr. Pete Mitchell. I'm Mike Weglarz. I'm the Director of Risk Management and Insurance at Eastern Kentucky University. I'll just introduce Peter a little bit here before we kind of get into our Q&A as well. So Pete is the managing director, head of private capital fundraising at PennantPark. Pete joined PennantPark in August of 21 as managing director, head of private capital fundraising. And before joining PennantPark, Pete was the senior vice president at Crescent Capital Group. And even before that, Peter was the senior portfolio specialist at Thornburg Investment Management, and then the managing director at Entrust Capital, as well as the Southeast director of sales at Snow Capital from 2005 and 10. So lengthy professional, distinguished career in finance, fundraising, capital fundraising, private capital. And then the unique thing, the great thing about Peter is kind of nice to know. Before his financial services career, he was a 9-year playing football in the NFL, spent 5 years in the Jacksonville Jaguars, 2 with the New York Giants, and 1 with the Detroit Lions and Indianapolis Colts. Also played in Super Bowl with the New York Giants. And then prior to that, his distinguished pro career. He was a 2-time consensus All-American while a member of the Boston College football team. Pete holds a BA in communications from Boston College University, or Boston College as well. So welcome, Peter.
Well, thanks, Mike. Great to be here. Excited.
Great. Yeah, awesome. Thanks. Can you talk a little bit more about your background, your role at PennantPark, and what actually PennantPark does a little bit?
Yeah, sure. So I got in this industry, I guess, gosh, almost 15 years or so ago, maybe a little bit longer than that. After I finished playing football, I was a communications major in college, so I wasn't really looking to do anything in finance. I had a 9-year NFL career, and about in year 4, I got married, started having kids, and started kind of taking a little bit more of a serious look at my finances with my financial advisor up in Michigan, where I grew up. And I really took a liking to sort of investments and all things investments. So I joined them right out of the NFL as a financial advisor, and kind of just learned the business that way, and realized that there's this other side to being a financial advisor. And kind of what I do now is raising money for funds in the institutional world, meaning I'm dealing with pension funds, endowments, foundations. All your police and fire departments somewhere roll up into a pension fund, whether it's their city or maybe even the state plan. So
national in scope.
Yeah, so national scope. So I travel all over the country. I travel really every week, which is part of the job. It's fun for a while. It gets tiring after a while.
Right.
But we, at PennantPark, what we do is we are a private credit manager. Think of private equity, and we're just the other side to that. It's a really unique asset class that really it's existed for a long time, but really nobody knew about it until after the financial crisis in 2008. Because the banks, most of the big banks before the crisis, did what we do.
Sure.
And then after the financial crisis, there was a lot of new regulations that were put on the banks as far as what they could and couldn't do. And one of them was loaning money to these kind of small and mid-market companies throughout the United States. So firms like PennantPark kind of stepped into that role after the financial crisis in 2010, 11. And most of the people that run firms like ours are people that were at those big banks that stepped out and now kind of wanted to do something a little more entrepreneurial. And because of the regulators, were able to start their own firms and manage money that way. So PennantPark has been around since 2007, so right before the financial crisis. So for us, that's great because we are seasoned. We've been through some cycles. A lot of our competitors haven't been through a time period like the financial crisis. So to be able to show our investors that we and our prospects, most importantly, that we can manage through a financial crisis, one of the worst that we'd seen since the 20s,
Sure.
Over almost 100 years. That not only did we get through it, but we actually had a positive return for our investors, which was hard to say for a lot of people.
You made me think a little bit. We might have a mutual friend there. My financial advisor, Brian Saxton, Went to
Yes.
Boston College as well. I don't know if I haven't talked to him in a while as well, but I don't know if you've connected with Brian. I know he played football at Boston College as well. So,
Yeah. He was my roommate there. So yeah,
oh,
a
geez.
good man, and does a great job. He's kind of what you call a registered investment advisor, kind of an independent guy now. He was
Yeah.
at I think he was at Wachovia, and then
Yeah. He's
uh,
at Safe Capital. He started
yeah,
his own firm. Yeah.
now he's at his own firm. Yeah, so it's a different personality, I think, for being a
Right.
financial advisor and kind of what we do.
Yeah. Yeah. Great. I'll tell him so you said hello. So
Yes,
small
please
world.
do.
So like we talk about how does it then the private credit then fit into and differ from the traditional bank lending markets?
Yeah, so the private credit world is what they consider most people consider an alternative asset class, right? So it's a little bit different than the public markets. Our stuff is not traded daily. It's not like a bond or high yield or a bank loan where you can get on the the exchange and trade it on a daily basis. Ours is sort of like private equity where a pension fund gives us money and that money's locked up for anywhere from 5 to 7 years.
Okay.
So we have the opportunity to loan that money to a company, and if it gets repaid, think about your mortgage, right? So you're getting it from a bank. They're charging you whatever it is, 5% interest. Uh, you pay 5% interest to that bank, and consider us the bank. And then at the end of the loan, you just hope to get your money back, and that's kind of what we're doing to these companies in the middle market. And think about what kind of companies we loan to. There's different sectors, but some that I think people can resonate with are HVAC companies, roofing companies, landscaping companies. So these private equity firms, and that's what we sort of partner with these private equity firms. They'll find they'll target a company that they want to purchase. Say they buy it for $100 million. They put $50 million of their own fund in there that they're raising from similar limited partners, the pension funds and so forth. And then the other 50 they'll borrow from firms like us. And what that does, instead of buying 10 companies, now they can buy 20 with that
Okay.
same fund size, but it also enhances their returns. Because anything, if we're loaning them money at, again, 5%, just use a random number, but their returns are 15%, that's a 10% spread that their LPs, that their investors are getting just by borrowing that money. So it really enhances their returns. And we do similar things on the credit side. We'll borrow money from banks, and so that we can loan to more companies. It enhances our investors' returns.
Do you set investor return expectations per se? Like, you kind of have a threshold that you'll guarantee like 5 to 7 return or 6 to 10
Yeah,
or what?
we do, but we never use the word guarantee.
I
That's,
can imagine that for sure.
we would get in trouble for that. But we do target sort of net
Sure.
returns, right? So
Yeah.
we have sort of our kind of traditional just direct lending fund, which is sort of senior loans. So it's the top of the capital structure. You're the first money to get your money back if anything goes wrong. Obviously,
Okay.
hopefully nothing goes wrong, but we'll
Right.
get our money back first. And so in those in that area, we have an unlevered fund, so we don't use that leverage that I was talking about earlier.
Mhm.
And we target anywhere from 7 to 9%, net return to the investor with that fund. And then we have a levered version of that where we put, if you give us a $10 million from the pension fund, we'll borrow 10 million. So it's really a $20 million loan for that pension fund. And so in that type of fund, we target sort of like anywhere from 10 to 13% net returns.
Wow.
So
Okay.
it's a great asset class.
Yeah.
And it's very it's not as volatile as the public markets because again, the public markets trade daily, and it could
Sure.
something so geopolitical could happen and the markets go down. It's not company specific. Where most of our loans and our investments are really company specific, and they don't trade every day. So it's very very kind of more of a slow, where we kind of slow rise up, and we just want to get investors their kind of net return.
Great. So I guess you kind of touched on what do you think are the key advantages and disadvantages then of private credit compared to other asset classes?
Yeah, so that's probably the biggest advantage. Well, one, because it's locked up capital, we get a little bit higher return for the investors.
Mhm.
So there's what we call an illiquidity premium that we get because that money's illiquid. And obviously, you only want to take money from investors that know they don't need it in the next 7 years or so. But what the nice thing about private credit is, it's kind of an income stream, right? So when we get our coupons from the companies, we then can distribute that to our LPs. Where in private equity is a little different. They don't get the income that we do. You give them money, and you don't really see your money till 10 years later when the fund ends. So that's the nice thing, advantage of what we do is there's an income stream. So like these pension funds have to pay benefits on a quarterly basis. They can use our income stream that would provide for them to pay those benefits. And then the other advantage is it's not as volatile as the public markets, kind of what I was talking about before. And then the negative is that it is illiquid, right? So you can't decide halfway through it, oh, I want my money back. It just doesn't work that way. There's all kinds of contracts.
Kind of like almost a CD, a bet at the bank,
Yeah, very similar. Where you can't, you got to hold on to it till it matures. And then the way ours work is we have like a 4-year investment period. So during that 4-year investment period, when the fund closes, we can recycle when we get refinanced out of a deal, right? Or that company gets sold to another private equity firm and we get all our money back. We can reinvest it to a new deal. But once that 4-year investment period ends, anytime we get refinanced out or paid off, we then have to just then hand that money back to our investors. And then that's kind of what they call the sunset period when the fund winds down.
Nice. Yeah. And I guess you're kind of going into I have just a couple more questions. Kind of current trends within the private credit market. It seems like it was years ago, maybe it was an anomaly, private credit, somewhere maybe in the back closet per se. But now it seems like it's coming to the forefront as maybe a desired option for companies to explore, investors to explore. Is that maybe a fair statement, or any other trends that you can share with us?
It is. Yeah. I mean, I think the hardest thing right now for us in the private credit market is competition. There's a lot of people getting into it. It's kind of like the hot buzz word.
You're right.
Class, because the returns for the last 15 years since the crisis have been so steady and positive, even in, we haven't really had any, headwinds. I mean, we've had a few headwinds. COVID was a kind of a blip, right? It wasn't a recession, right? We've had these really soft recessions. I don't think until you see a really deep recession is when you'll see a lot of these private credit managers that just kind of got into it late. And again, we distinguish ourselves out as seasoned veterans who've been through many cycles, have been through, the .com in the 2000s, and then the crisis in 2008. And our guys
experience.
Yeah, we've been doing it for 30 years. So
right.
We kind of know what we're doing, but there's been a lot of entrants over the last 10 years.
Yeah, absolutely.
And, are just, the most important thing at the end of the day, what we do is our investment team finds good credits, right? They're picking good credits that are performing companies. That if they do hit a recession, hopefully they will perform, they'll make it through it. That's the most important thing, is making it through it.
Yeah.
There's a lot of these new entrants, I think, that are just to win deals on the investment side.
Good point.
Are just throwing money at maybe but not so good companies. But they're doing well now because, everything's been really going, up to the right since the great, GFC. But the interesting thing will be is when there is, a deep recession, where happens to these companies.
And it seems like we kind of talked a little bit about before our conversation here, is that the recent interest rate environment, has that impacted access to private credit, and other companies exploring that as well? I think, in my opinion, I think the new normal is 5 to 7 range. Interest rates. I don't think we'll ever see that, maybe 2 or 3% rate. Do you think that's exposed access to private credit?
It not exposed access to it. It's made it more expensive, right?
Okay.
So the good thing about our business and our loans is everything is floating rate, right? So all our loans are tied to, or they used to be tied to LIBOR, which is sort of like this benchmark for credit, and it's now changed to SOFR. It's just a different name.
Sure.
But LIBOR really forever was zero, right? Since the GFC was basically at zero. So everything was tied off of that. So as interest rates rise, our returns rise. But what that means is the companies that we're loaning to now have to pay more interest, right? So if their balance sheet's out of whack, that can really affect their business, right? And that's where you see a lot of bankruptcies, when there's no liquidity at the company. Yeah. So going back to my point about the investment team picking great credits, it's important that there's a lot of metrics involved. That there's interest coverage ratio, which is how much cash does this company have to pay their interest, right? Do they have, is it 1 times? Is it 2 times? Is it 3 times? Before COVID, our interest coverage ratio was about 3 times. So on average, our companies that we loan to have enough cash available to them to pay their interest 3 times over.
Okay.
each quarter, right? So that's a good thing. It's kind of dipped down to close to 2 since COVID happened because a lot of companies were stressed financially because businesses were struggling, people couldn't travel, and people couldn't a lot of businesses suffered during COVID. So the interest rates do matter. I think you're right. I think it is we're kind of higher for longer. I don't think we'll ever see what we saw for 10 years plus, where interest rates were basically at zero.
Yeah.
We think they're in that kind of 3 to 5. Right now, SOFR, which again, all our loans are tied to SOFR, is at about 4.5. But then we're getting the illiquidity premium I talked about earlier. We're getting about 5 to 5.25 on top of that. So we're almost at 10% just on the our coupon that we're getting from the companies.
Wow, nice. And then, so everything can't be all quote unquote hunky dory per se. What
Yeah.
what are the risks associated with the growth of like private credit then as well, or in accessing like PennantPark's equity and funds?
Yeah, I think like what happens, and I kind of touched on a little earlier, is the competition that we see, right? So you see a lot of people in there. One thing, and not to get too deep in the weeds, but we have in every one of our agreements with our companies that we loan to, we have what we call covenants, right? And they're couple. We call them. I like to kind of explain them as circuit breakers, right? So there's maybe 1 or 2 or 3 in the documents that's each quarter they have to maintain certain covenants in their business, right? So if interest coverage, like I mentioned, if it drops below 2, we find out about it so we can get to the table and fix things, right? Before there's a bankruptcy, before there's a default, right? So but the more entrance into it, less companies are getting those covenants, right? So I think that's the scary part, is a lot of these, and a lot of it tends to be in bigger companies in the upper middle market, where you are then competing sometimes with banks.
Yeah.
And in that, when you don't have covenants, you really don't know what things are bad until there's a default. And then when there's a default, there's a bankruptcy, then you're scrambling to try and figure things out, right? So I think as it gets more competitive and as you get new and more entrants, you probably could have counted the amount of private credit firms, 15 years ago on one hand. Now there's probably a couple hundred private credit firms out there. So the competition is stronger, but we're seasoned enough. We have a good enough track record where we feel like listen, we're not, if our competitor's coming in and they want to loan something at SOFR plus say 400, where the market's really at 500, we'll let them do that. We're not going to compete for that because it's probably not going to be a good business.
Sure. Yeah. I mean, then the late entrance into the marketplace or space of what you're in may be exposed to a little bit more risk, and that because then they have to get business by offering better incentives, so they might expose themselves a little bit too. So
yeah, that's it. I would say one other kind of trend that you were talking about trends is that the private credit space really has never been available to the retail investor, to Brian Saxton or Safe Capital or Mike Weglarz. But they're now, over the last 3 to 5 years, they've been able to structure different or create different structures so that the private wealth world can access private credit. So that's a big growth opportunity for firms like us. We're in the process of doing that right now, where we'll be able to access Merrill Lynch brokers, Smith Barney, Morgan Stanley, Safe Capitals of the world. We'll be able to, because before the minimums were so high that not many ultra high net worth people could do it, and there's certain barriers that the private wealth people or retail investor has to meet. These new structures, you can have much lower minimums, so somebody could access our loans and our fund with $50,000, where usually it's $5 million for an investor to invest in one of our funds. So that's an interesting trend that's happening right now, as a lot of these managers are creating structures so that the retail world can access it. Again, it's illiquid, right? So that's the negative, but the positive, it's not, like your fixed income or your equities that you're trading, that are traded daily. These things are not traded daily, so it's a lot less volatile. And usually, if there's a shock to the system like COVID, as long as you can get through it and wait it out, those loans usually come back, and those companies are still performing.
Nice. Yeah, well, absolutely. I appreciate Pete Mitchell, Managing Director, Head of Private Capital Fundraising, PennantPark. I can't thank you enough for your time today. Thank you.
Yeah, thanks for having me, Mike. I appreciate it. Anytime. Love to do it.